Welcome, Graham Stephen from, scratch that. Welcome, Graham Stephen from BizVal. Great to have you on board, Graham. Now, we've spoken a couple of times before, so I'm very excited to actually get this podcast down and to spread the word about what you do. So great to have you.
Right. Nice to be here, Craig. Yeah, so we've chatted a few times before, so really looking forward to the conversation today.
Okay, well, let me give people a bit of an idea as to what you do. Now, I've written a couple of notes here. BizVal is a reporting process. Now, we've been through it. It's a pretty simple reporting process, but incredibly powerful and necessary. It's a tool slash system because it's not just a tool. It comes with people interaction, a tool slash system that guides you through the best exit for you and your business, giving you a model long before you actually exit. And I've described it to you, I think last time was, as a litmus test for your business, a health check, if you wish. How did that go? How did that summary go? Is that what it's supposed to be?
Yeah, Craig, I think that's a pretty good summary. I think the analogy I would use, and I love using analogies, it's as you say, it's like a health check for your business. I mean, think of it about your health. It's like you're going to go to your physician for an annual checkup and say, listen, doc, how long am I going to live? Am I good to go? So instead of just looking at purely from an accounting lens, we look at your business through the lens of, is it valuable and is it sellable? And the objective is to build a business that is that. And what our process and model does is it breaks it down into the core components of how much cash is your business generating, where are some of the key risks in terms of if an investor or buyer had to look at the business, what are the things that would make it attractive or not attractive to them? And then importantly, we go a step further and say, well, it's not just about having a number. It's not just about saying, hey, I'm going to live to 85 years and have a good life. It's actually what can you do to improve the value of your business? And that's really, really important. So you can run some scenarios. You can actually look at what your results need to look like to justify a particular value. So we've done all of that and made it really simple and easy to understand without losing the science, and let's call it the investment banking methodology that goes in the back end. Whether you're an advisor or a M&A expert advising a client, or whether you're a business owner yourself, it's a super powerful tool to help you build a better business.
It is now, you just throw that word in there, investment, that phrase in there, investment banking. Going through your history, you've got a fair bit of experience in that arena. So you really do know what you're talking about. You know what they're looking for.
Yeah, maybe just a touch back on that. I always tell the story is, my dad was a failed entrepreneur. well, he's still alive, and I mean that in the nicest possible way. He's 75 years old and he has to work. He was a millwright by training, got laid off, 40 years ago, 35 years ago, and ever since has been self-employed, climbing ladders, fixing things, but never built a business. And I thought, I'm never going to make that mistake. So I qualified as a chartered accountant, went into banking, worked with small businesses, consulting, got involved in startups myself, and then realized actually, you know what, there's so many business owners like that who've built a job. And I met my current business partner, Howard, who had done it the other way around. He's built 30, 40 businesses over, his 61 odd years. And he had got it right. He built a business that had value, that was sellable. And it's not a binary thing. It's something everybody can do if they want to, but they need to know, a lot of business owners don't know what they don't know. It's not about working harder. It's about working smarter and working on the right things in your business.
And that's the thing that I found with you when you walked me through this reporting process that you do. It wasn't just the modeling, it wasn't just the reports. It was the explanation for each part of the report. Each part, if I do this, then this will happen, and this will be. You went in and you had that background knowledge that you were able to explain it to me as to what the consequences were of each of the numbers and how it can affect your business. That I found particularly beneficial. And I had a coach, and he said to me once that you should always describe things in the language of a 12-year-old so that people can understand. And I feel that you did that, which was very important to me.
And maybe I should break that down for the listeners, Craig. So we believe that, let me just kind of break it down into sort of 5 or 6 steps. The first thing I just want to say as a principle is a business is worth what somebody's willing to pay for it at the end of the day. So it's willing buyer, willing seller. But that's a very generic and open statement. It doesn't mean a lot to a lot of people. But ultimately, one step down from that, it's a function of risk and reward. Okay. So what does that mean? Is how much cash profit can you generate as a business? How reliably can you generate that over a period of time? That's at its essence what a business valuation is. It's how much cash profit or cash flow does this business generate, adjusting for risk. So what we do is we break it down into a couple of parts. There's a few things that impact on that. So the type of business you're in, the region you operate in, how long you've been trading, those are all factors that impact on, let's call it the risk or the risk environment that the business operates in. So the first part that we do when we think about valuing the business is we say, tell us about the business, tell us about how long you've been trading, tell us what region and sector you operate in. So if you're a business operating in New Zealand, it's going to have very different fundamentals to that same business operating in the United States, for instance. So that's the first part of the conversation. So we have a conversation, and our process guides the owner, advisor through that conversation to kind of ground truth that. With an investor hat on, what that does is it says, well, what is my required rate of return? What is my discount rate, if you want to use that? So if I'm going to invest in this business, there's a required rate of return, and that is represented by risk or discount rate. Then we ask a few questions about how does the business actually make money? What is the business model of this business? Okay, so we have a conversation and we capture some information around that. Now, what happened 5 years ago in your business? What a lot of platforms do is they say, show me the data from the last 5 years and put a multiple on that. What happened 5 years ago is almost irrelevant today. It does give you a sense of track record, but think about this. We're 2025 now. A tourism business that was operating in 2019 before COVID came along, 2019 results are almost irrelevant. So we look at the current state of affairs in the business. How much revenue are producing? Where's that revenue coming from? How concentrated is it? Do you have one big customer, or do you have 10, diversified customers? Now, how much of that revenue is repeatable? Do you have customers that come to you once and then they disappear? Or do you have customers who come to you frequently and repeat customers? And then we look at the cost base of that business. So what are your salary costs? What are your costs of sales? All those things. But we adjust them for normalized expenses. So let's say, for example, you're an owner of a business and you're not paying yourself a salary. Now, clearly, if you're not paying yourself a salary, there's a problem, because if somebody buys that business, they don't want to buy a job. They're going to put an operator in there. So we make some basic adjustments for owner salary, things like rental, non-cash items, but nothing like kind of ridiculous, out of this world kind of stuff, but sensible stuff. So those are the first 2 steps. I don't know, Craig, if you want to take a pause there. So what's the risk of the business and how does it generate cash is the first piece we look at.
Where does all this information come from? Because if you go and ask someone straight off all this information, they're not going to know. They're going to have to go back through stuff to find this out. So do they look at their tax returns? Do they look at their accounting provider balance sheet and profit and loss? Is that where they get all this information from, or is it a combination of both?
I think it's a great question. So when we designed our process, we actually found that most small business owners, and when I say small business, we're talking businesses in the sort of $2 million to $30 million range, and I'm talking Aussie dollars. You can probably size of business. If you're talking US dollars, it's probably a similar sort of range, but the
I wish.
multipliers are slightly different. But most business owners in this, so you'd be surprised. Most business owners, and it's also an indication of how well does a business owner understand the fundamentals of their business. If I said to you, Craig, what is your annual revenue? You would have a pretty good idea. If I said to you, what is your monthly wage bill? You would have a pretty good idea. So it is a combination of the business owner kind of knowing 90% of the time what those numbers are. But also it's really helpful if you have got the right accounting records. And this is also a good indicator. If you've got accurate accounting records, be it management accounts or recent financial statements, we always recommend that you have those at hand because those should represent the fundamentals of the business. But it is a combination of both. I always say for a smaller business, the owner should be on top of those numbers and know those things almost like the back of their hand. And that also indicates, a lot about the owner, right? It tells you about are they in touch with the business or are they not? So it's a combination of both.
Do they know that?
Yeah.
No. I would say most would not know it. They would be making up the numbers, and they're going to be round figures all the way through.
Yeah. And you know what? That's important because as a business owner, you should know. You should know what your cash flow is. You should be able to plan. So if you don't know, this is a great process to help extract that. So that's the first part.
That's what I was trying to get to, is that this is a great place to start. Now, I recently did a podcast on a gentleman who produced specifically quality of earnings reports.
Yeah.
Now, that's going down in a bit more detail as well. So am I correct that your report is not the be-all and end-all of I'm going to go and sell this and this is what I'm going to get, this is what the private equity or the buyer is going to pay? It's not going to give you that. What I got from going over yours was it's going to lead me to the best possible buy price or sell price, as you may.
Craig, you're spot on. So, we aim to be 90% correct 90% of the time. At the end of the day, if you're going to go through a sale process of a business, there's going to be negotiation, there's going to be due diligence, there's going to be all those good things that. But there's always going to be a range. Okay. And that range, what we're trying to do is a lot of business owners chat to a mate at the cricket club or the golf club, and it's like, hey, I sold my business for 10 times revenue. Fortunately, there's a lot of that sort of banter and chat that goes around. It's not helpful because it creates unrealistic expectation. And also, there's a sort of, what we're trying to do is to be directionally correct within a range, so I'm not saying we're not accurate, within sort of a 10% range, but more importantly is what can you do to achieve that? If you need $5 million to retire on the Gold Coast and your business is only worth $2 million, well, you've got a problem. So best you understand, either you adjust your retirement expectations or you start working on that business so that you can improve it and get to that number over time. And that process can take anywhere from 2 to 5 years, depending on how ready your business is. And some businesses, maybe it's just not achievable. Maybe you're operating in a business that can't get to sort of the size that's in your mind. So that for me is the real power in this is, if you go for a health check and your doctor says to you, Craig, your cholesterol's a little bit high. You're carrying, an extra 10 kilograms around the waist, and your lung capacity is not great. You're either going to say, well, listen, I don't care, but live hard and die trying. You're going to kind of say, well, I'm going to, cut down a little bit on the drink. I'm going to exercise a bit more, and I'm going to eat a bit healthier. Those are the sorts of fine-tuning adjustments that you can make. And it's amazing how 2 or 3 small adjustments in businesses can make a fundamental, this is leverage, right? There's a leverage effect on value because what you do now has a multiplicative effect down the line. And that's really what we're trying to, the essence of what we're trying to demonstrate here.
On that growth side of things and changing the right numbers, I was listening to a presentation with a gentleman called Adam Coffey, who is a leader in the M&A environment in the world. And he was giving this presentation and he said, when was the last time that you looked at your sales price and your margins? When was the last time that you raised your prices? You People looked around and did a bit of a survey. A lot of people hadn't raised their prices in years. Right now, he said, when you get back, go and increase your prices. He said, things have changed over since COVID. Things have changed. He said, you need to increase your prices. And in today's
Yeah.
world, you can literally hop on my little program right there, and I can go and increase the prices by 20%.
Yeah.
What did that do to my EBITDA?
That's such a key point. You know, we talk about unit economics, right? And so whether it's your gross profit or your gross margin, and I guess you can hear by the accent, one of the advantages of coming from a country like South Africa is we're used to dealing with a lot of volatility, high interest rates, high inflation, you know, and that sort of uncertainty. I remember growing up, our inflation was running at 10, 11% every year. Companies would increase pricing by 10%. Now, that was just the way things were done. In some more developed markets like Australia, like Europe, like the US,
Not the
you know,
US.
business owners are not used. Yeah, maybe park the US, but they're not used to dealing with volatility. So it worked last year, it'll work this year. And I think people forget that, you know, inflation is real across the world. Australia has also got a commodities-based economy to a large extent, mining and minerals, and that's so these things influence things. So you have to look at, you know, 2 or 3% compounded over 5 years is like, you know, a 30% change in prices. So if you haven't kept up, global inflation has been running through the roof. Implement these. It's very hard to go to your customers and say, hey, we're passing a 40% increase. But if you have a plan to say every year we're going to put through 3% or 4% just to keep up with inflation, and you do that in a way that you're adding value, you're thinking about your costs, you're thinking about your efficiencies, that generates, you know, wealth, that generates cash flow. So again, it's habits over time that make all the difference.
I can't do that. I'll lose customers if I do that. The world will end because I'll lose customers. But what people don't think is the customers that you're going to keep are better quality customers with a higher profit margin.
100%.
You lose the dud customers.
Absolutely. And maybe from there I can kind of move into kind of the second part of our process. So, you know, it's a nice segue.
Actually.
Yeah. Well, halfway. We at the hump. Okay. So number 3, what do we look at after all these things is we then have a look at the working capital of the business. So how do you manage your working capital? So how much cash have you got in the bank? You know, so how much cash do you need to pay your salaries and your tax and all those good things? And have you got any excess cash in the business? So do you have an investment account that's sitting there with, you know, profits accumulating, or have you paid a dividend? Things like your debtors days and your creditors days. How quickly are your customers paying you? So for instance, a lot of small businesses land a big contract with a national retailer, and then suddenly they go from receiving payment from their smaller, let's call it customers, you know, on 10 days, suddenly it pushes out to 30 to 60 days. So little things like that, you know, how you manage your debtor cycle. Are you collecting on your debtors? How do you pay your creditors? You know, are you paying them cash on delivery? Are you paying them in 60 days? This one's a bit of an odd one because mathematically, you know, the longer you can defer paying your creditors, technically the better. But I find in small businesses, actually, you know, you're better off paying your suppliers quickly and consistently. Okay, so there's the math side to it, but there's also the human side to it. So if you pay your suppliers quickly, when you run into a bit of a challenge because somebody hasn't paid you, the supplier who you've been paying on time and communicating with and all of that is likely to say to you, listen, I can see you going through a rough patch. Let me give you a break. So there's the mathematical piece, but the part why having this human engagement in this process is so important is you can kind of drill a bit deeper into some of these things. If you just go take a spreadsheet and say, what are your debtors days? What are your creditors days? It doesn't tell you as a business owner about how you're managing those, how you're building loyalty with suppliers, how you're building loyalty with your customers. So that's the sort of third step, is understanding your cash and understanding how you're managing your working capital.
It is, because business is about people.
It is, yeah.
My son is 27 at this stage, and I've always said to him, he's in the IT arena, never screw your suppliers, your vendors, to the wall on price. because
Yeah,
if they're losing money, one, you're not going to get the best service, and two, they're not going to be around. So therefore, you're going to lose out
absolutely.
on every aspect. Every business needs to make a profit, and as a customer, you need to be there to make sure that they make a profit of some variety.
Yeah, I remember reading a book once called No More Mr. Nice Guy. And the title's a little bit misleading, but it was exactly around that is, you have to accept that one, there have to be boundaries, and two, everyone in the ecosystem needs to be benefiting. If your customers aren't getting value, there's a problem. If your suppliers aren't able to actually make a profit and extract, something's going to collapse in that ecosystem. So it's critical that you look after the value generating to your customers and how you treat your suppliers. So
Yeah.
yeah, that's sort of the third piece. Then after that, we look at the balance sheet. Okay, so the balance sheet is basically what assets do you have, vehicles, equipment. It will vary whether you're a manufacturing firm or whether you're perhaps a services-based business. We look at what debt, who do you owe money to? Do you have any outstanding loans or debt? And then also, importantly, do you have any fixed property? So when we value a business, we value the underlying business operations. And then we usually add the value of any fixed property. Now, if you own the property to the organization, but we make an adjustment on the income statement side to say, well, what would you pay as a fair rent if you own the property, for argument's sake? So, that's an important distinction we make. But we look at the balance sheet and we make adjustments to value based on that. So let's say your business is worth $10 million at an operating level, but you owe $2 million of debt to a bank. Actually, as the shareholder, when you sell that business, you're only going to get $8 million out. That's why looking at the balance sheet is important. The other thing we look at is on the asset side, if you've got equipment, a lot of people may have equipment that's been fully depreciated. So when you look at your income statement, there's no charge going through the income statement. Let's say you've got a manufacturing business worth $10 million worth of equipment and it's 10 years old. But that equipment still needs to be replaced at some point in time. So it's important to understand what that secondhand or replacement value is, and you need to make an allowance for that as a cash flow outflow, capex outflow. So we make those adjustments, but we explain that, advisors would explain that to the customer or the business owner as to why that's important. Sweat your asset until everything breaks. You have to make an allowance to replace. So those are some of the balance sheet adjustments we make. And then the last step of the process, before we do scenarios and that, is we think about the future expectations. So valuation is as forward-looking as it is backward-looking. So trying to understand, what are your growth plans in the next year? What can you actually grow at? What are your growth plans for the next 2 to 5 years? Do you need to invest more in expenses to kind of support that growth? Or do you have excess capacity? So those are key questions we ask to understand what the growth of the business looks like. So you can get a view of what does this business look like 5 years forth. So we use this information and the information we collected to build out a 5-year cash flow, let's call it, on the business. And then I love this question. We one of the single biggest issues with small businesses is that they're overly dependent on the owner. So we have a very simple question, and there are variants of this, but we say, what happens if you as the owner take a 3-week holiday or vacation? And we have answers like, well, I can go away for 3 weeks without my mobile phone on a beach in, I don't know, in Melbourne or whatever the case might be, or Gold Coast, and the business is unaffected. Through to, I'm running a food stall and, I can't even take a 3-minute toilet break when I'm busy. And it's a question that covers a lot of things because, if the business is not dependent on you, it means you've got systems, you've got processes, you've got accounting records in place. And that's one of the single biggest drivers of value in, let's call it, smaller businesses. So it's an important question. That is in essence the end-to-end process. It's a conversation around what are the key fundamentals of value. An investment banker or mergers and acquisition specialist or private equity is going to do exactly the same thing when they look at a business. They might go into a little bit more detail in some of the nuances in that, but it covers all the key elements of building out that cash flow.
Okay. And the benefit of going and getting this done by you, and I think you just fully explained what I meant by talking to people as at the age of 12 in your entire description there. But pretty much it was all understandable by people. But the benefits there are if you get on the front foot and work through this process of the business value in advance before you start going out to the entrepreneurs, before you start going out to the private equity companies. Get in front of it, work through the scenarios, figure out what you can change, what's going to have, through your modeling, what is going to have the greatest effect so that I can get the biggest payout when I do go out.
Absolutely.
And that's sort of what I meant earlier when in the intro, when I said this was a simple tool. I wasn't trying to be insulting in any way there at all. This is a simple tool that can give you the guidance, because the buyers, they're going to be doing this. You need to be doing it as the seller so that you can be in front of it and you know as much as what the buyer is going to know. Sure, you can go to an accountant and you can get all these whiz-bang reports that are going to go for pages and pages and graphs and everything, but you're not going to understand.
You hit the nail absolutely on the head. It's about empowering yourself as a business owner. So, business owners can use our platform directly. We also work extensively with other advisors, fractional CFOs, M&A advisors who actually would go through the process, because we have a team that would do that with the owner themselves. But we like working with partners because, they can add the other value. They can then go and say, let's go and develop a budgeting plan, or let's go and actually do the implementation of some of these. But it starts with empowerment and ownership by the owner. I just want to touch on one last thing, and you touched on that. Knowing what good looks like and what your income statement and cash flow needs to look like to support that valuation is key. So that's one of the things we give. But those scenarios we talk about is even more important. What levers can you pull? So we've developed, as part of the tool, a very simple slider-based platform. You do the valuation, and then there's a bunch of sliders you can move. You can adjust the parameters. So let's say, for example, you're sitting there and you're saying, listen, my business is making $500,000 profit a year, but I'm working hard. My family never sees me. But quite frankly, I don't want to go and spend another $120,000 on employing a manager or two IC, because I'd rather take that $120,000 and go on a nice skiing holiday to Europe every year. But that's very short-sighted, because that business is going to be very difficult to sell because you are the business. So what the scenario tool can do is allow you to say, well, what if I spent an extra $120,000? What if it then reduced the dependency on me? And what if, because of that, I could actually increase my sales growth, for argument's sake, from 10% a year to 15% a year? It allows you to go run all those different permutations and then see, hey, my value has gone from $1.5 million to $3 million, even though in the short term I'm spending more. And for a lot of business owners, they don't quite realize that, again, to use that health analogy, getting into those habits, spending a little bit more on organic foods. I mean, maybe that's a bad example, rather than processed foods, or
but you can't
is worth it in the long run.
You haven't got the information and you don't know.
Exactly.
You haven't got the compass to guide you. And that's
correct.
What your BizVal tool does. It is that
correct,
compass that gives you the guidance as to, I need to focus in on this. And then you can go out and say, okay, I know what I need to focus on. I don't know what I'm doing here. I don't know how to make that work, but I know that's what I need. Then go and find the right person to work with you to focus in on that, because you've done the modeling already. And then come back to you and say, hey, this is what I've done over the last 5 months. Can you just give me an update, please? See that I'm going in the right direction and I'm getting the value that I believe I should be getting.
And that's absolutely spot on. It's about regular checks. It doesn't have to be every 5 months. Maybe it's once a year. You go for those checkups, but also just having that independent perspective is so important. We have a saying in our business. We always tell the owner or the client what they need to hear, not what they want to hear. Everybody will tell you what you hear. Your coach will tell you what you want to hear. You can be an Olympic swimmer. A motivational speaker is there to motivate you. We're there to ground you in reality so you can actually do what needs to be done. And you know what? Most business owners are smart people. They built successful businesses. They know how to make money. They just sometimes need a reality check to say, okay, cool. This is how I can multiply this. And that's, I think, at the end of the day, what we do.
Well, we need them. They may be smart, they may be able to make money, but we need them
Yeah.
to eliminate risk and focus in on their exits. And that's what this is all about. Graham, this has been a very detailed conversation. We don't normally have them this detailed, but I think people have really understood what you do and how you do it. So we will have all your contact details at the bottom of this, as we always do. And
Yeah.
people just need to check in, check up. You spoke of health before. They need to go and do a check up on themselves and their business. And I'd be thrilled if they said, I need to bail out and get someone in so that I can make more money. That sounds counterintuitive, but it's a possibility. But you don't know
Yeah.
until you go through and do the check. Is there anything you'd
Absolutely.
like to finish up on, Graham?
Greg, I think we've covered everything. One, I just want to thank you for the opportunity to talk to your audience. I think if one thing that a business owner can take out of this, whether they work with us or somebody else, is just take the time to go and just get an independent reality check on where your business is at. And that's just a starting point. It's a checkpoint. That's what we're passionate about. I don't want to see business owners, quite frankly, ending up like my dad, having to work at 70, 75 years old because they didn't know what they didn't know. That's our big mission, is to shift the dial there so that 80%, I mean, this is a scary stat. I probably should have mentioned up front, 80% of small businesses aren't able to sell. They end up winding down. We want to shift that. Okay. It's not about the 20% who are selling. I mean, yes, we want to help them, but we want those 80% who can't sell to be 60%, 50%. I mean, ultimately 0%. And that's the mission we're on.
You're not the only one on that mission. But for the Australians that are watching this, time is coming up in 3 weeks. So this would be tax deductible. Go in, get it sorted. Thank you so much, Graham. Really appreciate your time today. And I think that last message was really crucial to everybody to listen to. Thank you so much.
Fantastic, Craig. It's been wonderful being here. Thanks to the listeners.